Most people buying a home in California do the exact same thing. They first find a property online, then they find a mortgage calculator online. They'll enter that sales price, they'll pick an interest rate, put in a down payment, and they get this payment and think, oh, that's something that I can afford, and that's what my housing expense will actually be. Except it's not. In many cases, it won't even be close, because the principal and interest payment at the end of the day is just a small portion of what it is to truly own and pay for a California home. You also have property taxes. You have homeowners insurance. If you're buying into an association or a condo building, you have HOA dues. And you may also have private mortgage insurance or PMI. And then California has a few surprises waiting for you after closing. Think of them as unwanted or undesirable housewarming gifts, like supplemental property tax bills, insurance premiums that are dramatically different than the original estimate that you received, and escrow adjustments that can suddenly, out of nowhere, just adjust your monthly payment months after you move into your home. Now, I've spoken with many homeowners that have experienced this very thing, and they weren't my clients to begin with, but we've since connected. And they'll always ask, how come no one explained this to us? And unfortunately, by that point, it's already too late. The deal is closed and the bills are already showing up in your mailbox. So in this video today, I want to break down the 5 biggest mistakes that California buyers make when they're calculating their mortgage payment, and show you how to budget for the real true cost of home ownership before you even get your keys. Now, before we do that, let me quickly reintroduce myself. My name is Arjun Dhingra. I am a lender here in the San Francisco Bay Area, where I have been for over 20 years. Most of my experience has been working with investors and first-time home buyers, and we've helped thousands of families and individuals put down roots here, own their piece, or make a real, true investment in this market. And if we can be of any help to you in this space, whether it's creating a short-term or long-term strategy, or you need to take action right now because you're actively looking, we would love to help you. Just reach out to me on Instagram at Arjun Mortgage. I answer all the DMs personally, and we'd be honored to help you. Let's first start with the number one misunderstood cost, and that is the supplemental tax bill. It's one of the biggest surprises waiting for you as a California buyer. And to understand it, you need to first know and gain knowledge on what exactly Proposition 13 is. In California, property taxes are generally based on the assessed value of the property. The total tax rate will vary depending on the county and the local assessment rates, but buyers can commonly estimate that anywhere between 1.1% or 1.25% of the sales price will be their annual taxes, and then when you divide by 12, you'll get the monthly tax rate. Now, that's a reasonable planning range if you're kind of estimating numbers and doing back of the envelope math, but if you want the true number for your county in the specific area you're looking to buy, make sure you consult either online to verify it or check with anyone who's actually helping you through this process. But here's where the confusion actually begins. The seller that you're buying the home from may have owned the home for 10, 20, or even 30 years. Their property taxes are going to be based on a much lower assessed value than what you're paying for it. So when the property transfers to you, the county reassesses now this range from what the seller was paying and what you are now paying. And this reassessment never happens at the time that you actually buy the house. It generally happens months after the fact. So it's not going to show up in your mortgage payment or on your first bill, in fact. There's usually a timing gap. And in that timing gap is when the county will send you a bill based on the difference between the previous owner's assessed value and now the new purchase price that you just paid. Now, depending on when you move in or when assessments are actually done in that particular county, you may get 1 or 2 special assessment bills. And these bills are going to be different than what your mortgage company is already collecting for monthly taxes, which are part of your mortgage payment, if you opt to have it be included as part of your monthly payment. Many homeowners in California like to have it included as part of their monthly payment. I call this the set it and forget it method, where you write one check for not only principal and interest, but also the monthly portion of property taxes and homeowners insurance. Other buyers opt to pay it separately because they like to keep their monthly mortgage payment as low as possible, and they'll deal with these other bills separately whenever they're due. But here's something that buyers actually miss. They look at their mortgage payment and they see that monthly taxes are actually being collected if they have an impound account. And so when they get this supplemental bill, they either dismiss it or think that it's already being taken care of, or that it was sent to them in error. But it's not a wrong bill or something that was sent to you in error. This is simply the county just trying to catch up once they took the time to finally reassess the value. So let me give you a really easy example. Suppose the previous owner was being taxed on an assessed value of $500,000. You purchased a home for $1 million. The county now needs to collect the tax difference between old $500,000 assessment and your new $1 million assessment for the portion of the tax year in which you owned the property. That difference can create a bill for several $1,000s. And if you were were not told to expect it, that can be a brutal surprise 6 months after closing. This is why I want buyers to understand their complete and total cash responsibility. Not only is it how much money do I need to close for down payment and closing costs, but how much should I keep available for some of these expenses that are going to happen or hit me after I move into my home. Your down payment is not supposed to leave you financially unconscious, guys. A smart purchase should require reserves that can be used for expenses that happen after you actually acquire the property, not just for acquiring it itself. Now, here's mistake number 2 that buyers make, which is using a generic insurance estimate. And this looms much larger in today's market and in this current environment where insurance is crazy and so hard to predict or even get. A lot of online mortgage calculators will use some generic formula or just a simple percentage of a home's purchase price. In California today, that will likely be wildly inaccurate. Insurance has quickly become one of the most important factors when buying a home. Major insurance carriers have either paused or restricted issuing policies in this state because of the regulatory environment, the risk of natural disasters. Properties near wildfire or flood areas, for example, are going to have really limited coverage options. And some buyers are now forced to have to use the California FAIR Plan as the only means of obtaining coverage. The FAIR Plan is intended to provide basic fire coverage where traditional coverage is difficult to obtain, but it may not provide all the coverage normally included in a standard homeowner's policy, which means the buyer may need an additional policy to cover other risks and liability. This is sometimes called a wraparound or difference in conditions policy. Now, the important point is this. The cost can be significantly higher than the number that generic calculator you found online is giving you. A calculator could assume that the cost for insurance will be $150 or $200 a month, for example. Then the actual quote comes back at $500, $700, or even more, depending on the property and the risk profile. Now, that difference affects 2 things. First, it affects your personal budget. Second, it affects mortgage qualification because the lender must now include the actual insurance expense in your debt-to-income ratio. I have seen transactions where the borrower qualified based on the original estimated payment, then the real insurance quote arrives, the debt-to-income ratio increases, and then suddenly the loan has to be restructured. Maybe the buyer had to increase the down payment, maybe they have to pay off another debt, maybe they have to bite on the interest rate, or in some cases, sadly, the deal no longer makes sense or it can't pencil out. That's why buyers have to obtain a real insurance quote now during the contingency period. Prior to this California insurance mess, you could just go off of a quote. But now, because of what's all involved and how consequential this particular part of the process is, you must obtain a real quote. So the correct question now, guys, is not can I obtain insurance? It's what will be the complete insurance structure cost? What does it cover? Can that cost change whether I qualify or whether I still even want the property? Now, the third mistake involves homeowners association dues. A buyer sees that a condo has a $600 HOA fee. They add $600 to the mortgage payment calculator and assume that the problem is solved. But the current HOA never tells you the full financial story. An HOA is responsible for maintaining the common areas and the shared components of the property. Depending on the community, that may include the roof, exterior siding, elevators, plumbing, landscaping, parking structures, balconies, insurance, security, and a long list of other expenses. Now, well-managed associations collect enough money to cover normal operations while also building reserves for major future repairs. Poorly funded associations, on the other hand, though, will have very little reserves. So when a major repair becomes necessary, the HOA has a few options. It can increase the monthly dues, it can charge a special assessment, or it can take out a loan and pass on the repayment cost to the owners. Now, that can feel like a second mortgage payment, even though it's not technically part of your loan. Imagine buying a condo with a $600 a month HOA. 6 months later, the association discovers major roof or balcony repairs. Now each owner owes a $25,000 special assessment. Maybe you have to pay it immediately. Maybe you can pay it over time. Either way, the true cost of you owning this property has dramatically changed. This is why buyers must review those HOA documents very carefully and see what's on the horizon, what capital expenses may be looming, what's been deferred, and you want to look at the reserve study to check that financial health of the HOA. Now, I experienced this in a condo building that I bought in the early 2000s. A major special assessment came due for the exterior condition of the entire building. This assessment ended up being roughly $15,000 per owner. Now, because it was only the second condo that I ever purchased, there were a few details, including this, that I missed. So when this bill came, it was a very, very uncomfortable surprise. So look at the meeting minutes, look for the discussions about deferred maintenance, the insurance problems, any litigation, upcoming projects, or possible assessments. And read more than just the colorful brochure showing the swimming pool. Pool looks fantastic until you discover that the HOA has $47 in reserve and the roof is being held together by optimism and duct tape. Now, a higher HOA payment is not automatically bad. Sometimes a strong HOA with higher reserves, higher costs, and proper maintenance is actually financially safer than a cheaper HOA that has ignored every major repair for 10 or 15 years. The issue is not simply how high are the dues today. Issue is whether the dues are sufficient, whether the association is financially healthy, and what expenses may be coming next. Now on to mistake number 4, being too afraid of PMI. This one's one of my favorites. Some buyers overestimate just how expensive private mortgage insurance can be. They believe that they must put down 20%, otherwise the monthly payment will be completely unaffordable. This is one of the biggest myths when it comes to buying property, but it's not always true. Private mortgage insurance, or PMI as it's referred to, is generally required whenever a buyer puts down less than 20%. But PMI is not one universal price. The cost can depend on a lot of factors, such as your credit score, your down payment, your debt-to-income ratio, the loan amount, and the mortgage insurance structure that's been selected. A buyer with excellent credit and a really strong financial profile may have a surprisingly low monthly mortgage insurance rate. In many cases, this PMI may end up being so much lower than what the buyer initially estimated or was afraid of, and this helps them preserve their liquidity. In fact, many of my more financially savvy buyers and wealthy buyers, they opt for taking out PMI because they want to leave their money working for them in the markets. They don't necessarily want to have to sell stock to make up this 20% down payment, and they'll take a short-term expense over the course of 8 to 10 to 12 months versus having to liquidate another 5 or 10% in the market. Remember, guys, equity is valuable, but equity is not the same thing as cash. You cannot use the equity that's in your home to pay for an unexpected expense unless you borrow against it or sell the home. There are also different ways in which PMI can be structured. There can be a monthly premium, there may be a single premium paid up front, or there are lender paid options where the trade-off is built somewhere into the interest rate of the loan itself. The right answer ultimately depends on the buyer. The lesson here is not that PMI is always good. The lesson is that PMI, when used correctly, is a tool, and it should be calculated and not feared. Don't let an outdated rule or paradigm that you cannot buy a home without putting down 20% stop you from being strategic. Mistake number 5, guys, the final one, is not understanding your escrow account. When you have an escrow account, the mortgage servicer collects money every month for property taxes and homeowners insurance. Instead of receiving the full property tax bill and paying for it yourself, part of the monthly mortgage insurance payment is placed into an escrow account. The servicer then uses that money to pay the taxes and insurance when they become due. In California, that will be annual for the insurance and twice a year for the property taxes. Now, for many buyers, this makes budgeting much easier, and it keeps the monthly expense of the mortgage payment more manageable. There are 2 important things that people often do not understand. First, the lender will likely require money up front to set up the escrow account. At closing, the lender may require or collect 4 to 6 months worth of property taxes and insurance to properly fund this new account. Now, that final amount depends on a lot of things, such as the closing date, when the bills are actually due, and the lender's escrow calculation. But this can add thousands of dollars to your bottom line at closing. Now, quick note, and very important, they are not closing costs because it's your money. It just needs to be collected because it's going to be held in this new account, which is yours. Should you refinance or sell the property, that money comes right back to you, or whatever balance is actually in that account. But the point here, guys, is that it still requires you to bring cash to closing. This is why a buyer may look at the down payment and closing cost estimate and then get surprised when the prepaids and escrow amounts are actually added to the total. The second issue is the annual escrow analysis. Each year, the mortgage servicer will review the account. It looks at how much was collected and compares that with what was actually paid for taxes and insurance. Now, if taxes or insurance increased, the account may have a shortage. The servicer then needs to recover that shortage and also collect more money going forward so that the account does not fall short again. That can cause a noticeable increase in the mortgage payment. For example, suppose that the insurance premium increases by $200 per month. The servicer will likely need to increase future collections by $200 now per month. But if the account was also short from the previous year, it may collect additional money to repay that shortage. This is why people can see their monthly mortgage payment jump by $300 or even $400 a month, even though there's been no change to their mortgage. The principal and interest may be fixed, guys, but the total mortgage payment on the statement is never fixed because the property taxes and insurance can always change. That distinction is incredibly important. A fixed rate mortgage means that your principal and interest portion is always fixed. It does not mean that every dollar leaving your bank account will remain the same for 30 years. So here is the real monthly mortgage payment formula. Your complete homeownership expense may include principal and interest, property taxes, homeowners insurance, mortgage insurance if applicable, and HOA dues if also applicable. You also have estimated maintenance, utilities, and an allowance for future increases or unexpected costs. For a condo, you should also evaluate the financial health of the HOA and the possibility of future assessments. For a property in a higher risk insurance area, you should obtain real insurance quotes early in the process and determine whether multiple policies are going to be needed. For every California purchase, you should expect supplemental tax bills and understand how the reassessing of the property value actually takes place. Now, don't get me wrong, guys. This might all sound like buying a home is going to be a bad decision. It does not mean that at all. It just means that home ownership needs to be a very informed decision. Buyers who struggle are not often the ones with the smallest incomes. They are the buyers that used every available dollar to qualify and pay for this property and left themselves no margin for anything else. The goal is not simply to become a homeowner, guys. The goal is to become a homeowner and not be terrified every single month when the mortgage bill shows up in the mail. Now, most buyers, guys, do not get their mortgage payment wrong because they're careless. They get it wrong because they are shown an incomplete number. Mortgage calculator can show you estimated principal and interest. It can estimate property taxes. It can estimate insurance. But an estimate is not the same thing as the actual cost of ownership. That supplemental tax bill is very specific. The insurance quote is very specific. The HOA bill is very specific. The HOA's financial health is very specific. The escrow requirement is very specific. And the right down payment and PMI strategy is very specific to each buyer. So do not ask, what will my mortgage payment be? Instead, ask, what will this property truly cost me every month and during the first year of ownership? That, guys, is the number that matters the most. So if you are buying a home here in California, guys, me and my team can help you calculate more than just a monthly mortgage payment. We can help you understand the property taxes, what the supplemental tax bill may actually turn out to be, insurance requirements, HOA impact, PMI implications, and the reserves that you should still have after the fact once you've closed. Our contact information is in the description below, as I mentioned. Please reach out to us on Instagram at Arjun Mortgage, and we would be honored to help you in any way that we can, putting together a strategy now or for well into the future. Thank you guys for watching this video. Hope you found it useful. It's an important topic. Please make sure to like this video, share it with someone that may find it useful, and we'll see you guys on the next topic.